Mullen Automotive, ticker MULN, is down again another 8% today. Obviously, not really surprising. This is all this stock does, is sell off. But what are key levels we can pay attention to? We can't go for the longer term levels like we normally do, because on a stock like this, they're just about, a 500% move to even come near to one of these levels. So all we can do is look at the 5-day and 10-day levels. What this means is if you're watching these levels, if you're watching this a week down the line, then these levels are no longer significant, because again, these need to be updated about every 3 to 5 days if we're paying attention to these close expiration levels. But to quickly note what these are, again, right now we're sitting around 41 cents. If we sell off, which is most likely going to be the way we go, we're looking at a 37 cent support and a 32 cent support. So those would be the kind of two close key supports I'd be looking at. And then if we had quite a big, significant move, we do have another support at 23 cents. So again, these are the three key supports I'd be paying attention to on Mullen for the next kind of 3 to 5 days. On the other hand, if we start to see an increase in stock price, which again, wouldn't be looking at for as much, we would have targets if you're long bias, or these can be short bias levels if you're more of a short bias trader or a trend trader. So we'll be looking at 48 cents, 53 cents, and 56 cents as key resistances if this stock pushes to the upside. Now again, it is hard to borrow, doesn't mean we can't short the shares, just means they're going to be more expensive. And again, we can always buy calls to define that risk, which I would always do, even though on a stock like this, I do think we will just continue to sell off and sell off and sell off. They'll do a reverse stock split, we sell off, sell off, sell off again. But it's all about being kind of prepared and kind of defensive. And in a stock like this, if you are shorting it, always make sure you are buying some sort of hedge. If that's just buying outright calls, just to make sure that risk is defined and you can't, blow an account on a trade like this. Because again, it always could happen. If you're shorting it, say 40 cents, could fall to, it could then push up to say $100 or $1. And again, you'll be down over 200%. So again, if we're trading anything like this short buys, even though the probability of it squeezing is going to be quite low, it's always about just defining that risk wherever we can. And again, considering the protection seems to be quite cheap, you can literally pay $1 per 100 shares. For the sake of that, it might make sense just to get that protection.